Good morning, everyone, and welcome back to webinar 2 in our series on financial intelligence. I'll just enlarge my screen here so you can see I've actually got some flowers in the background. My wife thinks I bought them for her, but actually I bought them to have something in the background when I'm doing the webinar, but don't tell her that because I won a few brownie points. There are no notes with this session. There's just the PowerPoint slides and the homework or post-webinar activity at the end. But there are lots of references at a slide at the end there, which has quite detailed information that can help you with all of the stuff that we talk about during the webinar here today. So there's generally a description on the left-hand side of the reference. They're all web-based references, so you should be able to just click and get more information if you're struggling with a certain point or issue. Okay, so let's get into a bit of the content for today's webinar, or a positioning of today's webinar, because in webinar 1 we did the financial basics, and also some feedback from webinar 1 where some people were suggesting that whilst it was of value, was it of great value in terms of the farm and making decisions? And I can understand that getting that basic information until we look at the decisions it can help you make might have seemed a bit tedious, or for some people it might have been something they already were very comfortable with. But we're all on the same page now. We've got some financial basics, and if you recall from webinar 1, we looked at the farm's financial position from 3 perspectives, exactly the same as how a bank would look at your financial position if you went for a loan. So we look at the past, which is to do with your profit and loss, what revenue and expenditure has happened. The expenditure is the costs associated with generating that revenue, and we need to match those two together. We looked at cash flows, which many people are very familiar with, and that's more about the here and now and what's happening right now, and can we pay our bills when they fall due. And then we looked at the balance sheet, which is more about the future and how have you set yourself up for the future, because we defined assets as something you own that has value into the future, and we defined liabilities as monies you owe that you've got a future obligation to repay. And what we looked at is that the difference between what you own and owe is called your equity, and that's a measure of your financial wealth. And we did discuss in webinar 1 that for most farms, even though you might have independent goals in the long term you're aiming for, if we were to summarize them, many of them would come back to sustainably grow your wealth in the long term. So we want to have more money available so that we have a bigger safety margin if there's a bad season. We want to have more money so we can invest in plant and equipment. We want to have more money to hand the farm over in good order. We want to have more money to improve our standard of living. All of these things come back to sustainably growing your wealth, which is measured by that equity. So we did see there were some links between the different financial statements. Cash flow, the cash amounts reported in your balance sheet, and the profit and loss is how you grow your equity. It's profit that grows your equity, not cash. So hence why we're going to focus quite a bit on profit and costs of production and that sort of thing in webinar 3, the next webinar we get to. So there's 2 sides to any financial transaction, otherwise our balance sheet won't balance, and we need to understand those 2 sides to understand the transaction fully. We looked at a couple of adjustments to take us from cash flow to profit and loss. Balance sheet information that we can use, and the main 2 adjustments we looked at in terms of creating a profit and loss from your cash flow was about matching revenue with expenditure. So if the revenue didn't happen this year, then it shouldn't be recorded this year. And similarly, if you haven't received the cash for this year's revenue, you need to make an entry to record that cash. So this has to do with increases and decreases in your tradable assets, stock on hand, grain, fertilizer, sheep, all sorts of things. And similarly, if we've incurred an expense this year but haven't paid for it yet, we need to record that. Or if an expense is, or a cash withdrawal is in this year's cash flow, but relates to a previous year or a future year's income, then we need to be able to remove that expense to match revenue with expenditure. And then when we have an apples and apples comparison, 2016's revenue with 2016's expenditure, we're in a better position to make decisions. The final adjustment we made was to your balance sheet and take it from a compliance type balance sheet to help record things for maybe the tax office, and move it into a management balance sheet that helps you make better decisions by changing the book values to market values and making sure we do that in a consistent and conservative manner, and over time building up a track record of the different aspects of your farm in terms of assets, liabilities, and equity. And so where are we heading from here now that we've just reviewed a bit around financial basics and webinar 1? We're going to look at long-term financial decisions. And you may recall the analogy in webinar 1 about Alice in Wonderland, you know, which road do I take? If you want to sustainably grow your long-term wealth, then you need to have some long-term goals and objectives. And those goals and objectives need to be considered when you're making short-term decisions. If you don't have an end destination in view, then often your short-term decisions can become very knee-jerk and responsive, reactive rather than proactive. You know, there's a good deal on fertilizer at the moment. Why don't I buy a whole heap? Well, you need to stop and think about, well, what's that going to do in the medium to long term, not just in the short term. So should I keep the lambs and sell them in a year or two's time and shear them another couple of times? That's more of a long-term sort of decision. It's going to have longer-term implications than just the short-term cash flow of not getting the money for the lambs. We need to balance those decisions and align them such that we get the best outcome. So longer-term decisions we defined, excuse me, in webinar 1 as that 3+ years, 3 to 4 years, maybe the rotation of your farm. Then we're going to have some medium-term decisions, which is more over the, excuse me, the operating cycle of your farm, which might be sort of 1 to 3 years, and looking at your profit and loss and cost of production to help guide those decisions. Then the 4th webinar, we're going to look at short-term financial decisions, which is largely around your cash flow and making sure that you've got enough money to pay the bills and you're optimizing performance in this current season. So that's within a season. This is across several seasons. And the longer term is, 3, 4+ type seasons. And finally, the last webinar, we're going to look at managing financial risk, the different issues that you need to consider across all 3 different time horizons to try and build your wealth in a sustainable manner. And the risk needs to fit with your profile. Otherwise, it's not going to be sustainable. So we've got some learning outcomes for this particular webinar, and they are listed on the PowerPoint there. First off, just re-clarifying the long-term goals for your farm. So I want you to think about, what are you actually trying to achieve? Actually, before I go too far on setting things up, any questions about webinar 1 and the context of webinar 2 before we get into the content for webinar 2? So just in the chat box, if you have any questions, I'll just give you a chance to type them. So we've got a question or two coming through. I'll change to my face so you can see me answer the question. Whilst we're waiting for the question, just think the goals that you're setting and how they fit in with that sustainably growing your wealth. Do you include GST in cash flow, and without GST in profit and loss on the balance sheet? Yes, good question. Webinar 4 around the cash flow, we'll talk a bit more about that, but I think it's definitely a cash flow issue because it's going to be money coming out of your bank account. But it's not a profit and loss issue because it's not your money. You're collecting it for someone else and you're paying it off to the tax man. So you're acting like a tax collector, if you like, for the tax man. Now, it will impact on your cash flow in terms of to that money or to send it off to the tax man. But generally at this stage, we're excluding GST from the profit and loss. In the balance sheet, it might show up when your accountant prepares the balance sheet based on if you owe any money in terms of GST, just to highlight that you owe that money. But we'll talk more about that when we get to the cash flow. At this point in time, excluding it because it's not yours. You're just collecting it, holding it, and then sending it on. Any other questions? Thank you, Christine. Much appreciated. Also appreciated. I'll go back to the slide so you don't have to look at me. Have firmly in mind what is your long-term goal, and we're going to be talking about how we can try and set some objectives and make some decisions that help towards that long-term goal. So that's the strategies that we need to overlay our short-term decision-making with if we want to achieve our long-term goal. So it's like a map in terms of you've got a destination and we're trying to navigate the best path in terms of getting to that destination rather than taking a long and winding road, as the Beatles once said. So our third objective is around benchmarking. So we're going to be talking about financial benchmarking, which is a little bit different to physical benchmarking. Now, we will talk about physical benchmarking, things around yield and that sort of thing in webinar 3, but we're talking about financial benchmarks here, things that your accountant and or banker may look at to determine your financial health. And these are going to help us in terms of determining the opportunities and threats in the farm for you to set some longer term objectives and goals to actually address those. So we're going to be focusing a fair bit on the balance sheet in terms of these longer term goals, because that is what the financial statement which covers much of the future rather than the present and the past. So having set some goals, let's just review a couple of things here in terms of the information we already have. So the homework activity from webinar 1, you would have built a profit and loss. So what we have here is a profit and loss that is very similar to what you've built, but maybe just summarized a bit differently. We've added some different figures together, so it's a very high level sort of profit and loss without the detail, because we're trying to use it as a learning activity rather than try to reflect reality exactly. So let's just look at things line by line and see where these figures come from. And review this high level whole of farm profit and loss. And we're going to use the figures in here to actually calculate some financial benchmarks. And that's why we've rearranged it a bit differently. So at the top there, you can see gross revenue, the total sales and revenue for the farm. And we've got a nice round figure there of $1 million. This will sort of vary and go up and down, I guess, based on the enterprise mix, the season, a whole range of different things. We've got some variable costs, and these variable costs in our previous activity, we talked about cropping costs and livestock costs. We're adding them together here to get total variable costs. Now, what variable costs are the costs directly associated with producing your revenue. So for cropping, I guess it would be the cost of harvesting and freight and fertilizer and chemicals. For sheep, obviously, it would be the shearing. It would be freight as well, I guess. It would be all of the costs associated with well, I'm going to use terms that I don't fully understand, but mulesing and I guess drenching and all sorts of things to keep the sheep healthy. And to get the wool off them and to get them to market. So the cost we can direct that we pay a contractor to come in and shear the sheep, that's going to be a variable cost. And we call them variable because often they move with the scale of the operation. The more of your revenue, the more sheep you have, the more tons of wheat you have, the higher these costs can potentially be. Depending on a number of other factors. And we'll look more closely at this in a future webinar. But if we just have a sense that variable costs go up and down and are directly related to each dollar of revenue. If we take our variable costs away from our revenue, we get something called gross margin. And this is for the whole of the farm. It would be your enterprise gross margins, your sheep, your wheat, your canola, your lupins or whatever, oats, all added together. If you were to do it on an enterprise level, we're looking at a whole of farm level, and we've got 625. 1 million less 375, 625. Then what we do is we take off overheads, and we separate overheads from variable costs because they behave differently. And because we can't allocate them or allot them simply to each enterprise we have on the farm. Overheads tend to be a bit more fixed in nature. They don't tend to go up and down with how much revenue we generate. So it might be things like interest, which is independent of your revenue, rates, leases that you're paying, insurance bills. Maybe you have wage bills that you actually pay to staff. These sorts of things are called overheads, and they behave differently to variable costs, so we separate them out. They tend to be a bit more fixed in nature, irrespective of your revenue. That's going to be your sort of overheads by and large. So if we take our overheads away from our whole of farm, we end up with this operating profit, sometimes referred to as EBIT. EBIT is an acronym. It stands for earnings before interest and tax. Simple word for it, operating profit. We have this subtotal because it's a good measure of the operating efficiency of the farm. Before you take off things that you have little control over, finance costs, tax, that sort of thing. Tax is dependent upon your tax structure and tax rates, finance costs on interest rates and bank margins and things like that. So operating profit, EBIT, is often seen as a good way of measuring how well is the current management of the farm managing the farm. Then we take off our finance costs, which could be lease and interest payments, and we end up with net profit before tax, in this case 180. Now we're going to take off drawings, or depending on the structure of your farm, might be called a management fee. This is the return for the effort you put in managing the farm. Okay, then we end up with some tax, which is dependent upon your tax structure, and in the very end we end up how much the owner's wealth has grown, 75,000 in this instance. That is your net profit after tax, and you've got to make some decisions about that 75 grand, what to actually do with it, and that's going to be critical to your long-term plans as to what you do with that discretionary amount of 75. Now the 80 we have in there of, if you own and run a farm, I think you should be getting money in two ways. You should be getting a return on the risk and the investment you have in the farm, which is down here in the profit, how much your wealth has grown. And you should be getting some money for the time and effort you spent in running the farm. You know, what would we pay a farm manager to do what we do if we didn't do it? If we don't do that, we could be kidding ourselves. We could put in a very low figure there and live very frugally, and it makes it look as if the farm's more profitable, and then all your ratios are going to be distorted because you have tweaked things to deliver a better outcome, because maybe it's a bad season and you're not going to take much out in drawings. For the purposes of working out ratios, we're better off putting in a figure that is more reflective of our time and effort. And it may not be what we actually took in drawings, but if we want to get a figure that we can work with and use and compare to others and compare to benchmarks and consistently compare from year to year, then let's put in a figure here based on what would we have to pay someone to run the farm if we weren't doing it. So the drawings, in my view, is more like a management fee. It's like the return for the effort you put in during the year. The net profit is the return you get for the investment taken in running the farm. Two separate ways to get revenue or returns on your investment in the farm. So we've restructured our balance sheet a little bit differently to come up with some different subtotals, but the information for this this profit and loss is from homework activity 1. So let's move on to just review a little bit around our current assets, our balance sheet. So our balance sheet, we're going to put into different categories, and the main categories are going to be current assets, current liabilities, non-current assets, non-current liabilities. And the definition of a current asset is something that turns into cash in the normal course of the business in the next 12 months. So we want to separate those out from the non-current assets which don't turn into cash in the next 12 months, because that's going to give us better information for making decisions. So you can see that current assets are your accounts receivable, your lambs that you've got to sell, any grain on hand, any fodder, these things that turn over and turn into cash reasonably quickly. Our non-current assets tend to be different in nature, and they tend to be our plant and equipment, our land and buildings, and we manage our non-current assets differently to our current assets. We might be rotating current assets. We might be looking for the best market price to sell at a short notice. We might be having to store and manage and deal with our current assets. But our long-term or non-current assets, we tend to sort of set and forget. We put a maintenance plan in place, we use it as best we can, but it's a different form of management to our current assets. So we're going to separate those out and have a current asset total and a non-current asset total. And together, the 156 current assets, together with the 4210 non-current assets, gives us our total assets of 4366. On a similar basis, if current assets turn into cash in the next 12 months, then current liabilities are due to be paid in the next 12 months. So we've got an overdraft that we need to sort of try and get back to zero. We've got some accounts we need to pay, and we've got some lease payments due in the next 12 months, and they're all there. This gives us a good sense of potentially the cash outflows that are happening over the next 12 months. And then we've got some non-current assets. So beyond 12 months, we've got this big term loan that we need to try and pay off and pay the interest on. And we've also got the lease on that equipment beyond 12 months. So the next 12 month payments are 8, and then beyond 12 months, the repayments are about 70 there. So we've got some current assets, current liabilities, sorry, 146, and we've got some non-current 920, and together they add up to 1066. Sorry about the zero dropping onto the next line there. If we take 1066 away from our total assets of 4366, we can see that our equity is 3.3 million. You can also see some letters beside each one of these, and we're going to use those letters to calculate ratios. And there were some letters actually beside each one of our profit and loss items as well. So when you are doing the homework, those letters will help you work out the ratios with an example I'm going to show you in a minute. So just a brief stop there in terms of are we quite comfortable with the profit and loss and the rearrangements we've made, and indeed the balance sheet and the categorization of assets and liabilities into current, non-current, so that we can get some better information. Any questions around that rearrangement of our financial statements so that we can work out some ratios? Can't see, no, Katie's fine. So I'm going to assume people are sort of pretty happy there and move on to let's work out some of these financial benchmarks and ratios with our next slide. So just try and keep with the sort of current slide, with the current line, rather than try and jump ahead. If you jump ahead, we might miss some interesting, important information about each particular line. The first thing I'd point out in terms of working out the financial ratios and benchmarks for this farm would be that there are 4 broad ratios that most financial to determine your overall health. The first one is liquidity, and that basically means can you pay your bills when they fall due? And that's an expression we've used as we've been talking about cash flows, etc. The second set of financial ratios have to do with efficiency. How well is the management of the farm turning inputs into outcomes? How well are you taking the costs and generating revenues, if you like? How efficiently is that being done? Is there wastage? Could that improve? Third set of financial ratios have to do with profitability. How much profit are we making? Are we making not enough profit? Are we making too much profit compared to our peers? And maybe in the short term that's okay, but in the long term not so good. What is the growth in our wealth? And is it relevant for the risk that's actually been involved? So profitability are going to be some important ratios. And lastly, we look at debt. And the flip side of debt is equity. So have we borrowed too much? Have we not borrowed enough? Do we need to focus on repaying debt? Or do we need to focus on being more efficient? Or do we need to focus on generating better profit? Or do we need to focus on having enough cash to pay our bills when they fall due? So there's questions associated with each of these four broad categories. And we've got a sample of 11 ratios. There's a lot more than 11 financial benchmarks or ratios. We've tried to zero in on some of the main ones. And we've color-coded them in blue in terms of short-term focus, red in terms of medium term, and green in terms of long term. So ones today, but we will explain the red webinar 3 and the blue, which will be discussed more in webinar 4. So by dividing current assets into our assets into current and non-current, and our liabilities into current and non-current, we can now take our current assets and divide them by our current liabilities. So if you look up the balance sheet, you'll see S beside current assets and W beside current liabilities. So we've got 156 as things that will turn into cash in the next 12 months, and then we've got 146 as things that need to be paid out in the next 12 months. So that difference between the two we call working capital. And take away your current liabilities, you end up with working capital, which is ratio number 2 there. And in our case, 156 minus 146 gives us $10,000. We would prefer our working capital not to be negative. That is, we have more money going out in the next 12 months than we've got coming in. We would like it to be positive, and in this case it is positive. But it is only $10,000, so it's not a significant positive amount. So I've got some question marks beside whether that's a good figure or not, because it depends on the time of the season that you're actually comparing. Definitely at the end of the season, end of February perhaps, you would want this to be positive. If you've received some money come in and you've got all these payments coming out for the coming season. If it's negative, then you're going to have an overdraft to actually cover that. So it depends on the time of season, and I think a better indication of liquidity might be when we look at our cash flow budgets. Because similarly, we can divide our current assets by our current liabilities, S divided by W, and get a ratio. And for this sample farm, it's 1.1. And many people would say, if it's less than 1, then that's a bit of a typo. It should be less than 1. It's not good, because you've got more liabilities than you have assets in the next 12 months. And a lot of banks would like it more than 1.5, especially once you've received all your grain payments and that sort of thing come in. But it depends when you're selling sheep, when you get paid, that sort of thing. So I think we better maybe reflect more on the cash flow when we get there than look too hard at liquidity ratios. Efficiency ratios are quite important. So we've got some here in terms of the amount of revenue we've generated, A, from our profit and loss, divided by the assets, our total assets in the balance sheet, V. Another way to say this is, for every dollar of asset, how many cents of revenue are we generating? And in this case, we're generating 22.9 cents. We would obviously like this figure to be larger rather than smaller. And the broad benchmarks we have here are between 15 and 30 cents in the dollar. A lot of this will depend upon your enterprise mix. It will depend upon the value you've put on your plant and equipment, the value of your land. But all those assets you want to use efficiently to generate revenue. And this is a bit of a measure of whether you're getting better or worse at that. So we might Last year, we generated 25 cents in the dollar on our assets, and this year only 22.9, and the season was similar and lots of other things were similar, we might go, maybe we haven't used our assets as efficiently and we need to look at what can we do? Could we maybe lease some land to someone rather than farm it ourselves? Could we maybe do some contract harvesting if our plant and equipment's not being used efficiently? Could we change our plan with our sheep such that those assets are generating more revenue rather than less revenue? So I've given this one a tick for our model farm because it's in that sort of ratio, and towards the middle. I'd like to know what it was last year before I got too comfortable with that. We also have an input ratio where we take our variable costs, B, from our profit and loss, and divide them by our revenue. So another way of saying this is for every dollar of revenue, how many variable costs, how much were our variable costs? In this case, it was 37.5 cents. These are the livestock and the cropping costs, those that we can directly relate with each enterprise. And whilst the margin here, we would like this to be lower rather than higher. And that would be a good sign of efficiency if we can get a better yield using the same inputs. If we can earn more revenue from our sheep using the same costs to produce those sheep. So it's a measure of their operating efficiency. And the broad guidelines here are quite broad, 25 to 40, depends on your enterprise mix. The fact that it's towards the top end, I've put a bit of a question mark there because it might be a negative trend. You know, we went 30, 35, 37.5. And if there's no other reason for that happening and we're not changing our enterprise mix and the seasons aren't that much different, then maybe that's a bad trend. So I'd like to ask a few more questions about that ratio to see whether I'm happy with it or not. Operating profit ratio, we take our earnings before interest and tax, our operating profit, and we divide it by our revenue. So after we take off our variable costs and our overheads, how many cents in the dollar is left? Similar ratio to the input costs, but this includes overheads. And we're saying 27.5 here, which is once again towards the top end, but a lot of that's being caused by the variable costs, not so much the overheads, because it's this one's very close input cost ratios towards the top end. And our operating costs is towards the stronger end, actually. So we've actually probably got quite good overheads because it's taken us from the bottom end of this range to the top end here when we take our overheads away from our gross margin to get our operating profit. Then we go right down to the bottom and we take our net profit ratio before we take off tax and drawings, and we divide it by our revenue. And in this case, we've got 18%, which is less than the bottom end of this range. So I've got a cross beside that one. So the difference between our operating profit ratio and our net profit ratio is our finance costs. So we take our finance costs away from operating profit to get our net profit before tax, G. So I would think here that there's a problem and an issue in that we're paying a lot of interest and maybe a lot of lease payments, and we need to try and focus on reducing that because we're underneath the bottom end here. So let's look at the longer term ratios and then we'll have a bit of a break so you can stretch your legs, etc. Plant to gross income. So the value of your plant compared to the revenue it's helping you generate. So U is your plant and A is your revenue. And the ratio here is saying, look, it would be nice to be more than 1 to 1, and you don't want to, actually you don't want to be more than 1 to 1. That is a lot of plant and not much revenue. And if you're using your plant efficiently, maybe it's going to be less than 0.8. I guess this ratio could be too low as well in terms of if you haven't invested in your plant and equipment, this ratio might look quite good, but it might be holding back your revenue. The other ratios are suggesting that maybe if I had more revenue, the net profit ratio wouldn't be as bad. So maybe there's an issue in that that might be too low. So we've got to ask some questions once we see these ratios. Return on assets is about, we take G, and if we flick back up, we can see G is our net profit before tax, and we divide it by our total assets. In this case, our return on assets is 4.1. And the range we're talking about here is between 2.5 and 5. This is a good ratio for this sample farm. It's within the range. It's also something you can use in terms of, should I be borrowing money to invest in the farm? Should I get into more debt? And my answer here would be no. Unless you can borrow the money at less than 4.1%, then why would you borrow money at 6% to buy some new plant and equipment when the return is only going to be 4.1 on average? So you need to be very careful about making that decision that you're not actually borrowing money at 6 and getting a return of 4.1 on the asset you've bought. You're losing money, 1.9. Now, there's a few more things you need to consider in terms of buying plant, but return on assets is a good one to compare to your interest rate to sort of say, is it worthwhile borrowing money? Or should I be using some of my profit to make that investment rather than borrowing from the bank? Or maybe 50-50, because if I bought that plant and equipment with half my own money from the farm and half from the bank, then the effective interest rate instead of 6 is now 3%. Now it makes a bit more sense. If I can generate a return of 4.1 on something that's costing me 3, I'm making 1.1% on that investment. Return on equity is a measure of our profitability before by comparing it to how much equity we have. For each dollar we've got invested in the farm, how many cents are we making? This is an important ratio to compare to other investment options. So it's also an important ratio to compare to risk. So this farm's making 5.5, which is above the strong range. So that's a positive ratio. If I had the opportunity to invest in a business in town, if I looked at how much I was investing and what profit it should make and divided the profit into what I'm investing, I would get a return on equity on that other investment. So it might be useful to actually compare that to, what if I invested that money in the farm? What sort of return would I get? If I can then align the risk of the two different investment options, look at the return that it's actually giving me, then I'm in a better position to make a decision whether to make that off-farm investment or whether I should use that money maybe to reduce debt. Because if I can reduce debt that I'm paying 6% on, then that might be a good option when this off-farm investment is only generating a 4% return on equity. So good for comparing investments and aligning your decisions to risk, return on equity. The final two ratios around debt, equity to assets. How much of the farm do we own? Very interested in this one. Because their security is largely tied up in the assets of the farm. More particularly, it's tied up in the land and buildings on the farm. The current assets tend not to be taken into account that much by the bank. And the plant and equipment, they sort of write down quite a degree. So they're really looking at the value of the land against how much loans you have. From the business perspective, we can look at how much you own of your total assets. And the ratio here is saying somewhere between 70 and 90 would be a good range. And the higher, the better. At this point, we're towards the low end, 76%. So there's not a lot of safety margin there. A devaluation in the land, a poor season, and we need to borrow money to keep going. It's not giving as much safety margin to actually invest in the business. So whilst it's acceptable, maybe we'd be happier between 80 and 90 rather than at 76. So we're going to look at that one a little bit more closely. And here's a key one that the banks look at. They take your E, which is your operating profit, which is earnings before interest and tax, and they divide by your F, which is your finance costs. So it's a degree of safety margin. How many times is your earnings before interest and tax, how many times does it cover your finance costs? And in this case, it's 2.9 times. Banks would say, we want it 3 times or more. But for operating your business, somewhere between 1 and 2 is the closer to 2 would be better. So that's above 2, so that's a positive. So if I was to look at all these sort of figures in terms of strengths and weaknesses, I would say there's a bit of an issue potentially around finance costs, or potentially it's around the revenue. And if we got more revenue and made more profit, the finance costs would look a lot better. And that might have to do with our investment in plant and equipment might be holding back our potential to generate revenue, even though our revenue to assets was okay, it's at the lower end. So maybe that revenue to assets figure could improve if we can generate more revenue from our existing assets, and that might involve investing in some assets to generate that more revenue. And if we do that, then potentially our net profit ratio could improve. We seem to have some capacity down here if we do need to borrow some more money to make that happen. Our interest coverage is quite good, and there is a little bit of margin there as well. So a bit of an overview in terms of looking at the farm from a financial health perspective and a financial benchmarking perspective. So why don't you have a bit of a think about that, and the balance of the webinar is going to be taking some of those ratios, especially the green ones, and saying, well, what sort of decisions can we make based on that? So have a think about it. Any questions you have, and I'll ask for those. You can type them in during the break, and we'll get back underway in 5 minutes. Okay, so let's get back underway. Question from Sarah there. Is your balance sheet, in your balance sheet, where do you get the figure for the overdraft? It's a bit like how you pronounce certain words. I say potato, you say potato. Tomato, tomato. Some people put it in under current assets because cash in the bank is an asset. Some people put it under current liabilities because if you're overdrawn, it's a liability. So in your current assets, if you're overdrawn, it's going to be a negative figure. It's going to be in brackets. If you put it in your current liabilities and it's and it's overdrawn, it's not going to be negative because it's a liability. It's money you owe. If it's a positive balance in the current liabilities, it's going to be there as a negative. It's going to have brackets around it if you put it in your current liabilities. So make a choice one way or the other. I would tend to put it in my current assets in the hope that I've got money in the bank. And then when I see it as a negative, I know that it's actually overdrawn rather than put it in the current liabilities. So that would be my sort of suggestion. Depends how you've set up your accounts, though, in terms of AgriMaster or any of the financial programs you're using. Should you use the up and coming cash flow, that is the coming year's figures, or your last year's cash flow figures? So far, we haven't looked at cash flow because all our figures for our financial health have been taken from last year's profit and loss and balance sheet. So we haven't drawn any figures from the cash flow. At the start of the year, you're going to have a cash figure, which is the end balance of last year's cash flow, if that's the question you're asking. I would suggest, though, the coming year's cash flow is good for determining your liquidity rather than maybe using some of those earlier figures. That is the liquidity figures, the working capital figures. I would tend to use the coming year's cash flow as a better indication of whether I can pay my bills on time or not. Thank you, Sarah. Good questions. Well done. So let's take some of these financial ratios and start to say, well, how can we use them to make better decisions? So there's a few things we need to be aware of as we use any benchmarks, and financial ones are no different, is the consistency of the measure. Are other people using the same formula as us? Are they calculating the data the same way? Sometimes there may not be comparisons available. You may want to compare certain ratios and you can't find them. And indeed, you might just get an average or a broad range where you want to find, well, what are the best farms doing rather than what's the average farm doing? So the benchmarks are often sort of averages. We'd prefer to be more towards the top end than the bottom end, and understanding what the top 25% of farmers are doing rather than the bottom 25. Ratios can be impacted by the scale of your operations. So bigger farms can spread their overheads across more revenue. So that makes some of their ratios a bit more attractive. because of the size of the farm. So it can vary where you sit in those ranges based on the size of your farm. Obviously, good, bad, average seasons are going to have a big impact. The time of the year, and whether you're about to sell some sheep or you're about to sell some wool or some other timing issue creates a difference. So we need to be careful of that. Definitely, if we're comparing from year to year, we want to compare at the same time each year. And the fact that these averages and ratios and benchmarks are not your farm. They don't have your enterprise mix. They don't have your goals. They don't have your farming conditions. They don't have your history. So very difficult to compare if you've got significant differences in any one of those issues. Having said all that, I'd rather have an understanding of where I sit rather than not. It then becomes, what can I do to use benchmarks more effectively to make better decisions? And I think there's a range of things that many people do. Many people use a trend over time and whether we're getting better or worse rather than absolute figures. Many people average ratios over a period of time to take out the impact of seasonal variations. So that can be a good approach. If you can get ratios that are for your farming area and region, that might be more appropriate and relevant to compare yourself against. We definitely want to align our results to what are we trying to achieve with our business plan and our overall goals. And it's really about continuous improvement rather than, where exactly the exact figure. If we're getting better over time, then that's the result we're sort of aiming for. So let's focus on trends and improvements and keeping a track record and a history of our results. And ratios and numbers aren't the total answer. They might be the starting point for a discussion. So it might identify a problem that you can talk through and work out a solution. It may not give you a solution. And indeed, when you examine it further, it may not even be a problem. We need to use other financial information in addition to our own results. And this might be around our cash flow and our cost of production. We want to benchmark against ourselves as much as, or even more so, than others. And that might be the most accurate way to benchmark. How are we going? Are we improving in the medium to long term? Because there might be some short-term fluctuations, but are we getting better in the medium to long term? So given that, it's still worthwhile to have some financial objectives and goals that we're aiming for. And it will help us in terms of answering some very broad long-term decisions about how we sustainably grow our wealth. How do we improve that equity over the next 3 to 10 years? What are some of the decisions we need to make? How much profit should we reinvest in the farm? How much should we take out on living expenses or beyond living expenses as a reward for all the effort and risk that we've taken? So what do we do with that net profit at the bottom there? Because we've got two options. We can leave it in the business to help it grow, or we can take it out of the business in the form of dividends. And we could invest it for our retirement. We could do lots of things. If we leave it in the business, we could buy more assets. We could pay off debt. We can do lots of things with it. In terms of those investment options or reinvestment options, when we take that profit, we might look at things like super, farm management deposits, buying new plant, upgrading existing plant, reducing debt, leasing or buying more land, maybe an off-farm investment, maybe improving our working capital so we don't have to use the overdraft for the coming year, maybe building a bit of a contingency fund against a poor season. So these are important decisions to make, and we need to make short-term decisions that align with our long-term goals. And if you think about it, how you make those decisions is going to be dependent upon your risk profile, your preferences, your situation, but it's also going to be very dependent upon the life cycle of your farm. So what do I mean by the life? If we look at a farm over its life, then this might typically categorize some of the stages it goes through. If you consider time down the bottom in years, and it might be over the total of the graph, it might be a 20-year sort of time horizon or longer. And if you look at the vertical axis and we consider that as maybe your equity to assets ratio, what percentage of the farm do you owe? Remember in the previous slide, we were talking between 70 and 90%. So 70 would be towards the bottom here, and 90 would be towards the top there. So we're suggesting if you don't own a lot of the farm and you're back towards the 70%, you're in the emerging stage. And your focus is about trying to grow the equity in the business to reduce your financial risk. Having invested in the farm and grown your wealth, then you enter a period of consolidating that wealth. Pass through consolidation and you get more into leveling off of your equity to assets ratio, and you're getting a bit more comfortable. You've got the debt under control. You've invested in plant and equipment. You're generating reasonable profits fairly consistently. You're in that maturity stage, and you're questioning whether to invest in the business or not, especially as you lead towards retirement, depending upon what your retirement plans actually are. So really what we're doing here is putting the life cycle of the farm against the percentage of the farm you actually owe and trying to build that percentage over time, because that is sustainably growing your long-term wealth. And many of your goals fit within that broad financial goal as a long-term financial objective. So let's look at each one of these stages separately and some of the decisions that you can or should be making within that that stage. So we're going to look at emerging and growing together, because often the decisions you make are fairly similar. When you're in the early stages and there's a high financial risk because your equity is quite low, the focus is obviously on building equity. So let's look at how we build financial equity with our next slide. One thing we can focus on, obviously, is to be very efficient. That input cost ratio we looked at. How can we get more revenue for the same amount of inputs? Or if we improved our inputs a bit, will we get an even bigger return in terms of our revenue? So is it worth buying some extra fertilizer to get an extra yield in terms of our crop? Is it worth holding on to those sheep and getting another clip, I think, of wool before we actually sell them? What can we do to improve our productivity in the short term is going to generate more profit, and that will help us invest in the business to help it improve its equity position. So we can focus on our mix, our efficiency, our profit and loss, and these mid to short-term decisions that impact on those. We can try and grow the scale of the farm is another focus at this point in time as we're trying to improve our equity. And I guess there's a few options here. We could look at things like increasing our flock size if that's going to help our revenue to asset ratio. So our decision here is, by investing and growing the scale, is the return in terms of revenue going to be worth it? And that revenue to asset ratio can help us. Maybe we could buy some extra land somehow if we have the financial capacity to do so, or if not, maybe we could lease some. Bearing in mind we're at quite low equity levels, maybe leasing is a better option. Share farming, some other sort of option to try and improve the scale of what we're actually doing, increase the size of things. And the third thing we can focus on in this emerging and growing stage, the early stages, is we could look at investing in capital and maybe plant, especially if that investment, the returns are more than the costs. So we've got to keep the costs down at this point in time. So this is about for that extra equipment are more than the extra costs. So it's an important decision. We'll examine this a bit further in a little while, but maybe at this stage, rather than new equipment, we're looking at second-hand equipment. Maybe we can't afford that capital investment and we need to get a contractor in for certain tasks and jobs because we've increased our scale, but we can't afford the capital investment. And while we're doing all three of these things, we're trying to keep a very tight watch on our cash flows. And maybe people are even trying to minimize their drawings to reduce that cash outflow on the business, to leave money in the business. Importantly, see that as an investment in the business. The money you didn't take out is you investing money back into the business for you to be able to get access to that money in the future. So some key focuses if you're at the early stages there. What about if you're more at the consolidation stage, which is our next slide? What are some key decisions that we can make here? One, focus a bit more freely on buying assets because our equity is built up a bit and we have some capacity to actually buy. We could invest in property and yards. We could invest in machinery, especially if our return on assets is going to be more than that interest rate, that point we talked about before. A strong focus here might also be around reducing your debt further to get more towards that maturity stage and build a greater safety margin. Reduce your interest risk expense, reduce the risk, and improve your borrowing capacity just in case there is a need to borrow money down the track due to a poor season or a major breakdown, that sort of thing, or a change in operations and maybe a significant increase in the flock size, for example, or an upgrade of your yards. And the third thing we can do is maybe invest some of our money back into the business. And we could use this to upgrade plant and equipment. We could look at new opportunities that we haven't taken on before within the farm, or maybe even outside of the farm. We want to make sure that our profit's not suffering from a lack of investment in our plant and equipment, because we were quite tight on that as we were in that emerging and growing stage. So I just want to zero in a bit on this issue of sort of investing in plant and equipment and look at some key sort of questions that you might need to ask yourself as you're considering buying plant or equipment. And there's the questions there. You can read them as well as I. Have a think about that. So some good questions there. And from a financial perspective, how might we sort of answer those? When should we buy and not buy new plant or equipment? We should buy it when the returns outweigh the costs. The extra money we get and the profit we make from that plant and equipment is more than the extra costs. And to do that, maybe we need to look at ways to optimize our use of that equipment and not have it idle for any excessive amounts of time. So multi-use sort of equipment or contracting out equipment and earning money that way. So the key thing here is looking at the benefits outweigh the costs. And what we're looking at here, when we consider the costs and the benefits, is the full cost of ownership, not just the operating costs. We're looking at the extra costs compared to what we're currently doing. So if we're upgrading plant, the extra cost, if the operating costs are the same between the new plant and the old one, then there is no extra cost in getting that new plant. So we're looking at the incremental, not the total, but we're looking at the full costs, not just some of the costs. In fact, if new plant and equipment is more efficient and going to save on fuel and be more efficient in its use of resources, then that is actually a benefit in getting that new plant. So that is like revenue. It's a reduction in your costs. So that could be a benefit to consider in terms of weighing up against the costs. So we look at extra, additional, incremental, depreciation, interest, insurance and rego, all of the different costs involved, not just some of the costs. But look at the incremental, not the total. Which plant and equipment should you select? Well, this is going to vary from farm to farm. You know, what aligns to your business plan? What are your strengths and weaknesses, and what are you trying to address from that financial health check you did? What does your budget allow you to do? When did you last upgrade? What is the ease of use and functionality and the safety issues with that equipment? How well and quickly could a breakdown be dealt with? So there's lots of non-financial considerations in terms of buying plant and equipment that you need to take on board. But if you want to take on the financial considerations and prioritize between different options, one thing you could do is take all the costs of ownership and divide by the benefits of ownership. So how much is this new plant and equipment going to cost? And then how quickly will the benefit cost? This is called a payback period. And if you do this for several different options, you know, I could upgrade my yards, I could invest in more technology for my sheep, I could increase my flock size. All of these are investments. I could buy a new header. All of these are investments. If we take the total costs and then divide that by the benefits each year that it's going to derive, then that will give us something. And the shorter the payback period, the better. And that might be a useful rule of thumb in terms of selecting between different options that you have in terms of investing in plant and equipment. So that was really at the consolidation stage. As we move into maturity and looking towards retirement, our focus starts to move to more things like clearing of debt, maybe a greater consideration of off-farm investments, which might help us in our retirement, and definitely things around tax management, averaging of your profit, farm management deposits, superannuation. Your accountants and financial advisors will be able to give you better advice around that. But at this stage, you're at a degree of comfort, and you may not be looking to invest in the business and take the risks associated with that to generate more profits. It probably depends a fair bit on your transition plan and your risk profile and your personal preferences. Are you handing the farm over to the next generation? Are you going to lease it out? Are you going to try and sell it? That will impact some of the decisions you make towards that end of your life cycle. And in the end, what you're actually doing is trying to decide what to do with that discretionary income, hopefully that you have, at the bottom of your profit and loss. Once you take out your drawings, you've paid all your interest, and you've paid all the variable costs and all the overheads, that bit at the bottom, what am I doing with that? And here's how one farmer has actually addressed that. And they've come up with a range of different options to spend that discretionary cash. And the first one sort of says, put some off the term debt. And then the next chunk of money between 21 and 40 would be used to upgrade plant. And then the next chunk, what I like about this mix is that there's elements in here that make it sustainable. If you never take any money out of the farm to enjoy the benefits of having a good year, a performance bonus, for example, or take a special holiday if you've done really well, then it becomes very much a grind. So if at all possible, we need to build some sustainability by saying, well, let's celebrate our success to a degree and balance that with the need to invest in the business to continue our growth of wealth in the long term. Now, your mix of what you do with your money and discretionary spend is going to be up to you. Maybe you don't need to break it down into 20, 30, 40 grand lots. Maybe you do it in 50s. Maybe you have different priorities based on the life cycle of your farm and your risk profile. But that's your decision, and it's a decision that people involved in the running of the farm need to make jointly. It's not just the people in charge of the books, it's everyone involved in the running of the farm. And setting that objective will help you make short-term decisions that drive you towards your long-term outcomes. There's some references for what we've actually talked about today, and the linkages are there, and a bit of a description of each one as well that might help you in terms of any of the specific information we've spoken about. Let me just get back to a bit of a wrap up in terms of a summary of the things we've spoken about. And as I'm summarizing, any sort of key questions you might have or key learnings from the session or feedback on the session, I'm going to ask for that in a minute. So have a listen to a bit of a summary and try and give me some feedback as to any key takeouts, feedback on the session, etc. What we've started with was rearranging our profit and loss and our balance sheet into different subheadings and headings so that we can make more sense of the information that's actually there. And this allowed us to produce some financial ratios and compare them to some benchmarks. Now, whilst these ratios have some limitations, we're better to have them than not. And maybe we need to compare with ourselves as well as others and see the trends over time, whether we're getting better or worse. So building up this history over the life of the farm. In terms of making decisions to improve our long-term wealth, these are long-term decisions, and they are dependent upon, to a degree, the life cycle of the farm. Think about where your life cycle's at, and this will be a financial consideration in the decisions you make. And those decisions might be around debt, investment in plant and equipment, buying more land or leasing more land, spending money on yourself, minimizing tax, preparing for retirement, depending what life cycle you're at. Importantly, get all the different stakeholders on the farm involved in understanding what those longer term decisions are, implications of those decisions. So that's a bit of a summary of what we've spoken about today. Thanks very much, guys. I'll wrap everything up there. Talk to you later.